GE is a poster child for what I was talking about. So they are splitting up. They split up their healthcare unit. GE puts out a press release. And one of my big things is the reliance on pro forma metrics. I think a lot of corporate fraud is happening right in front of your very eyes by abuse of pro forma accounting metrics. GE's press releases are anywhere from 15 to 30 pages of adjustments. And GE is a good example of what we talked about. It is basically up 60, 70% as earnings estimates have come down. Venerable GE right now is trading on our numbers at 20 times EBITDA for 2023 and 40 to 50 times declining earnings. That's GE, right? And that's with all the adjustments. They barely made any money last year on a GAAP basis. And so people I don't know exactly what they're looking at in some of these companies, but they're not looking at the financial statements.
We were talking about how, the move that the stock has made, and it just doesn't make a whole heck of a lot of sense. And I think that this would be a name that could get hit really hard if the S&P were to kind of come back in and people were inclined to take some profits. I mean, this stock, guy, at its lows in September, at the end of September, early October, was like $48. Okay. So to me, this is one where I want to use options. I want to define my risk. I want to be a bit contrarian here. And I want to look out to March expiration, giving some time for this to play out. Again, they're not going to report earnings for a while, I think, until late April. So today, when the stock was trading on 81.50, it's a little below that. Now you could look at the March 80.70 put spread. It would cost you about $2 buying one of the March 80 puts for about $2.50, selling one of the March 70 puts at about 50 cents. So again, that max risk is $2. What was interesting to me about it when the stock was 81.5 is, like, normally you would expect something kind of that near the money to be a quarter of the width of the spread. So it was a little less than a quarter of the width. And so if you paid $2 for this, you had profits of up to $8 between 78 and 70, with a max gain of $8 below 70. And then you would have losses of up to $2 between 78 and 80, with a max loss of 2 above 80. What I really like is that risk reward. I'm risking about 2.5% of the stock price. I have break even down about 4.3%, and I have a max potential profit of 4 times the premium I have at risk. So again, I'm keying off Jim's take on this thing. Listen, when he shorts things, he's not trading things. He's looking longer term, and he's waiting for things to play out. This is about a month and a half here. And so, as always, I would use about a 50% mental stop. So if I paid 2 and the stock was going against me, going higher or going sideways, and this thing was decaying, I'd look to cut this thing if it was only worth $1. We do not want to see puts, put spreads, calls, call spreads, long premium directional things go to zero in our trading books here. So that's how I'm playing Jim's call on GE. What do you think of that trade?
Makes sense. I think, to your point, you're actually taking advantage of what seems to be some pretty reasonable vol in this. And if you're going to be right, and I think you have enough time to do this, I think this one could pay off nicely. The Caterpillar trade only took a couple days, and that worked out really well.